Thank you all for joining me on this Thursday evening for another night of VITA TCE training for the 2024-2025 tax season. Tonight we will wrap up this version of training. This will be the last evening of training, but this is if after tonight, if you need any assistance, anything from me, I will leave my email address in the chat box as I have on any other training session. So if you need any further assistance from me after tonight, you are more than welcome to reach out to me. If you don't write down the email address, or if you don't receive it, you are more than welcome to reach out to Hunter. He can provide the information to you to reach out to me, so that if you have any other questions after tonight, feel free to send me an email. I will respond to you. On Saturday of last week, also on Tuesday, we did go over the volunteer standards of conduct. We also went over the intake, interview, and quality review training. We did also go over the certification questions for the volunteer standards of conduct, as well as the intake, interview, and quality review training. We did also go over the Lincoln Learn landing page, as well as how to input those questions and answers into the certification page. And if you don't remember how to go to that, we will cover that tonight, as well as I want to get as far as we can into the advanced certification portion of that test. All right. On Tuesday, we did hop into the tax law portion of the training. And so tonight we will pick back up on where we left off. If there are no questions or concerns that any of you have for me before we do that. Are there any questions or concerns before I pick up on where we left off?
No, ma'am.
All right. If I am not mistaken, we left off on retirement income. And if that is the case, that is where we will pick up. Can everyone see my screen?
Yes.
Yes.
All right.
Yes.
This lesson will help you identify and report the taxable portion of retirement income received by the taxpayer. To do this, you must understand the types of retirement income and the forms used to report them. You should also be able to recognize when taxpayers should adjust their withholding and determine which forms to use. For more information on the topics discussed in this lesson, see Publication 575, Pension and Annuity Income, Publication 590B, Distributions from Individual Retirement Arrangements or IRAs, Publication 721, which is a tax guide to U.S. Civil Service Retirement Benefits, and Publication 939, which is a general rule for pensions and annuities. The objectives for this lesson: you should be able to identify how retirement income is reported to the taxpayer using Form 1099-R series, calculate the taxable portion of different types of retirement income, determine how to report retirement income on the tax return, and determine when an adjustment to withholding should be made. All right. What is retirement income? Retirement income can include Social Security benefits, as well as benefits from annuities, retirement or profit sharing plans, insurance contracts, IRAs, etc. Retirement income may be fully or partially taxable. For information about Social Security benefits and Tier 1 railroad retirement benefits, you will learn more about that in the Social Security benefits lesson. Retirement income is usually reported on Form 1099-R series, CSA, CSF, RRB, or 1099-Rs. Those forms indicates the amount received, the taxable portion, and the taxpayer's cost or the investment in that retirement plan. In your publication 4012, you will see the publication or the Form 1099-R, which you see a screenshot of that Form 1099-R on the screen. This will be something that may be common that you will see as a tax preparer. Sometimes that form will show in box 1, you will see the gross distribution on that 1099-R. 2A will show the taxable amount most times. Sometimes it won't have the taxable amount, and you will have to figure what that taxable amount is. You'll have to use a simplified method of you'll have to calculate what that simplified method is, and that is figured using the calculation that's built into that software. And we'll go more into that. I'll show you, there's a simplified method that I can show you once we get into the software. Retirement plan distributions. Retirement plans are funded by either before tax or after tax contributions. This funding status determines if the distribution from the retirement plan is taxable. If the taxpayer did not contribute to the retirement plan, all the distributions are fully taxable. If the taxpayer made all contributions to a plan with before tax dollars, the entire distribution is fully taxable. If the taxpayer made all contributions to a plan with after tax dollars, then the distributions will be partially taxable. The portion that represents earnings is taxable since it has not been previously taxed. It refers you to your publication 4012 under the Form 1099-R. Taxable IRA distributions. What is the difference between distributions from a Roth IRA and a traditional IRA? Roth IRA distributions are generally tax-free because the contributions were after tax. Traditional IRA distributions may be fully or partially taxable because the contributions may have been deductible or non-deductible. Additional taxes may apply to non-qualified distributions from a Roth IRA. Taxpayers who made non-qualified Roth IRA distributions should be referred to a professional tax preparer. Distributions from simple and SEP IRAs are in scope for VITA TCE because they are taxable and are generally reported on the return, just like taxable traditional IRA distributions. Note, distributions from simple IRAs in the first 2 years, which is listed as a code S, can only be rolled over tax-free from simple IRAs. Taxable simple IRA rollovers are out of scope for VITA TCE. Reporting IRA distributions. Distribution codes on Form 1099-R. Form 1099-R has explanations also on the back of the Form 1099-R. Distribution rolled directly into another qualified plan are not taxable, which are listed as a code G. Generally, eligible rollover distributions paid to the taxpayer are not taxable if they are rolled over to another qualified plan or retirement account within 60 days. Roth account rollover is code H. Taxable pensions and annuities. When are pension or annuity payments fully taxable? Taxpayers do not pay any part of the costs of their employee pensions or annuities. Employers did not withhold part of the cost from the taxpayers' pay while they worked. Employers withheld part of the cost from the taxpayers before tax pay while they worked. There are two methods used to figure the taxable portion of pension or annuity payment. The general rule, which is out of scope for the title, for VITA TCE, or the simplified method. The 1040 instructions has the simplified method worksheet, but again, the simplified method is built into the TaxSlayer software. And so if you receive a 1099-R and the taxable portion is not figured or not shown on that 1099-R, you will use the simplified method to figure out what the taxable portion of that distribution is. The disability income from a retirement plan is taxed differently depending on the taxpayer age. Before minimum retirement age, taxed as wages. After minimum retirement age, is taxed as pension. Some distributions are subject to additional taxes computed on Form 5329. Only Part 1 of Form 5329 is within scope. Lump sum distributions, premature distributions, required minimum distributions, and withdrawal of excess IRA contributions. When should a taxpayer adjust their withholding? You want to discuss with the taxpayer if they owe $1,000 or more on their tax return. Most times when a taxpayer owes when you've completed their return and it shows that they owe, most times the taxpayer knows the reason why they owe, especially if they owe more continuously. If they continue to file their return, they owe. They know the reason why they owe. If it's the first time that they are owing on their return, then it's a surprise and they don't know. Most times it's because they're not having enough withholding coming out of their paychecks, and so sometimes they need to adjust their withholding. And so taxpayers can request withholding to adjust their withholding using a Form W-4P, a Form W-4R, or a Form W-4V. If they are not having any withholding, taxpayer may need to make quarterly estimated tax payments. And so you want to refer the taxpayer to the publication 505, tax withholding and estimated tax, in order to learn more about having withholding or making estimated tax payments. Any questions on retirement income? Out of scope for this lesson is if a taxpayer has to file a Form 8606, if non-deductible contributions are made to a traditional IRA, if taxpayers are subject to an additional tax due to excess IRA contributions, if a Roth IRA distributions that are taxable or partially taxable, and those with Form 1099-R with the code J or T, if they have a distribution with codes 5, 8, 9, A as in Apple, E as in Edward, K as in Kite, N as in Nancy, P as in Paul, R as in Rose, and U as in Umbrella. If they have IRA rollovers that do not meet the tax-free requirements, if part of a distribution is a return of after-tax contributions that may require a Form 8606, if the general rule is used to figure the taxable portion of pensions and or annuities for past years, if they have a Form 1099-R with a distribution code of A, which means a lump sum distribution qualifying for special tax treatments, or if they have contributions to a simple or SEP IRA. All right. We will move right along to Schedule K. Schedules K1 and rental. This lesson covers the reporting of certain income from Schedules K1, which is Forms 1065, 1120S, and 1041. This is not something that is common in a VITA TCE site, but it's something you may see. Volunteers who certify at the advanced level are permitted to prepare a Schedule E supplemental income and loss only with Schedule K1 with items identified in this lesson or Form 1099 miscellaneous, Box 2, royalties with no associated expenses. Rental income and expenses are in scope only for military families renting their personal residence. Taxpayers are not required to report income and expenses if their home is rented less than 15 days during the year. Rental income and expenses are in scope only for the military course. Volunteers must certify at military level to prepare Schedule E for rental income. At the end of this lesson, you will be able to identify Schedule K1 income items that are within the scope of the VITA TCE program, determine how to report Schedule K1 income items, determine how to report Schedule K1 income items, determine which types of income, rental income must be reported, identify how to report rental expenses. Schedule K1 may report information that is not needed for an in-scope return, such as investment income or foreign tax credit for per country detail. It is not necessary to enter that information into the software. A Schedule K1 is used to report the taxpayer's share of income, other distributions, deductions, and credits from partnerships, S corporations, and some estates and trust. One copy of Schedule K1 is sent to the IRS and is later matched with individual returns. Another copy of Schedule K1 is sent to the taxpayer. Ask taxpayers if they received a Schedule K1 from such an entity that reflects their share of income, reportable on their Form 1040. It is important to correctly report this income to avoid notices or correspondence from IRS. Income reported on Schedule K1 will be included on the taxpayer's return in various places, depending upon the type of income. Income reported on Schedule K1 that is within the scope of VITA TCE programs include interest income, dividend income, qualified dividends income, Section 199A, dividends, net short-term capital gains and losses that's reported on Schedule D, line 5, net long-term capital gains and loss that's reported on Schedule D, line 12, tax exempt interest income and royalty income that's reported on Schedule E. On Schedule K1, which is reported on Form 1041, the fiduciary of a domestic decedent's estate, trust, or bankruptcy estate uses Form 1041 to report income, gain, losses, etc. of the estate or trust. Royalty income that's on Schedule E is only in scope if the source document is a Schedule K1 or Form 1099 miscellaneous, Box 2, royalties with no associated expenses. Rental income and expenses. Generally, income from renting a room or home to a tenant is reportable on Form 1040 Schedule E. Property must have been rented at fair rental value. If not, income and expenses are reported differently and it is out of scope. There are two methods of accounting: cash basis, which is most common, and the accrual method, which is out of scope. What are the common deductible rental expenses? Mortgage interest, which is split between Schedule A and Schedule E if only part of the home was rented or if the home was rented for only part of the year. Property taxes, if any part of the property tax is a special assessment for local benefits, it is added to the basis of the property and is not deductible. Property insurance, auto and travel expenses related to the production of income, standard mileage rate, actual expense method is out of scope, and property repairs. Repairs versus improvement is a common source of confusion. Repairs means that you keep the property in good operating condition and the costs are current year deductions. Improvements mean that you add to the life or material value of the property, prolong its life, or adapts it to the new uses. Costs must be depreciated over the useful life of the improvement. Depreciation. Some examples of depreciable property are buildings, machinery, furniture, vehicles, improvements to the rental property. Land and land improvements are not depreciable. There are three basic factors to determine the amounts of depreciation: the basis of the property, the recovery period of the property or for the property, and the depreciation method used. Rental versus personal use. The personal use of a dwelling unit can limit deductibility of rental expenses. Mortgage interest and property taxes are allocated separately on both Schedules A and E if there is personal use. You want to review the worksheet for figuring rental deductions for a dwelling unit used as a home in publication 527 and under chapter 5. Passive income versus active participation. Taxpayers who are not active participants may not deduct rental losses that exceed rental income. There are two restrictions on how much a loss from passive activity can offset other sources of income. There's an at-risk rule, meaning taxpayers can claim a loss only up to the amount for which they are personally at risk in the activity. And the passive activity rule, meaning losses that exceed rental income are not deductible. Again, it refers you to the publication 925 for more information. When reporting passive rental loss, the Form 8582 is generally not required if the taxpayer has only one passive loss generated from a rental activity and an AGI of less than $100,000. If there's any doubt, you want to always refer the taxpayer to the IRS or to a professional tax preparer for more information. Any questions or concerns on this lesson? All right. In summary, taxpayers receive Schedule K1 to report their share of income from flow-through entities. Interest, dividends, and capital gains are in scope. Schedule K1, page 2, lists the appropriate forms and schedules where taxpayers' income from these sources should be reported. Additionally, royalties on Schedule K1, Forms 1065 and 1120S are within scope. Volunteers who certify to the advanced level are permitted to prepare a Schedule E only with the Schedule K1 and limited Form 1099 miscellaneous income items. Rental income and deductible rental expenses are reported on Part 1 of Schedule E, supplemental income and loss. Volunteers must certify at the military level to prepare a Schedule E for rental income. Rental income and expenses are in scope on military families renting their personal residence. Unemployment is the next lesson. It's a super short lesson. At the end of this lesson, you will be able to identify unemployment compensation income, determine how to report unemployment compensation on the tax return. Unemployment compensation generally includes any amount received under an unemployment compensation law of the United States or of a state in the US. In most cases, unemployment compensation is taxable. If taxpayers contribute to a governmental unemployment compensation program or a governmental paid family leave program and the contributions are not deductible, amounts received under the program are not included as an unemployment compensation until the taxpayers recover their contributions. If the taxpayer has already deducted all of the contributions to the program, the entire amount received under the program is taxable. Unemployment compensation is reported on Form 1099-G. Again, it is taxable in most cases. It's not considered earned income for calculating EIC. On the screen, you see a screenshot or a snapshot of what a 1099-G normally looks like. In box 1 is where the unemployment compensation is shown. Box 4 is where you will see if any federal income tax withheld will be shown. Is on your 13614C, there is a box. If the taxpayer received unemployment compensation, they should check whether or not they received it, answer yes or no. They should have the Form 1099-G with them to show that they received any unemployment compensation. Generally, taxpayers must include in income all unemployment compensation received. If the Form 1099-G shows the wrong amount of unemployment compensation, the taxpayer should contact their state unemployment agency to correct it. They want to enter the amount of unemployment received shown in box 1 or box 5 of Form 1099-G on their Form 1040. They want to enter the amount of withholding from Form 1099-G, box 4 on Form 1040. If the taxpayer had more than one Form 1099-G, you want to enter each form in the software. If the taxpayer repaid unemployment compensation received in the same tax year, the software will subtract the amount repaid from the total amount received and enter the difference on Schedule 1, Form 1040. Any questions or concerns on unemployment? We're going to move right along. Social Security benefits is our next lesson. And if at any point I'm going too fast, I need to slow down, or if there's a question, I may not see the chat box or the comment box. You all can come off mute and ask any questions that you need to, or stop me at any point to ask any questions that you may have. All right. Social Security benefits is our next lesson. This lesson will help you assist taxpayers who have Social Security and equivalent railroad retirement benefits. These benefits may or may not be taxable. The intake and interview sheet lists Social Security and railroad retirement benefits in the income section. Ask the taxpayer about the receipt of either of these benefits. The Social Security Administration issues Forms SSA 1099, Social Security Benefit Statement to Social Security benefit recipients. The Railroad Retirement Board issues Form RRB 1099, payments by the Railroad Retirement Board, and Form RRB 1099R, annuities or pensions by the Railroad Retirement Board. It refers you to publication 575, pension and annuity income, and publication 915, Social Security and equivalent railroad retirement benefits, for additional information on the topics discussed in this lesson. The objectives is to determine the taxable portion of Social Security and railroad retirement benefits, determine the most advantageous method of reporting lump sum Social Security benefits, and report Social Security and railroad retirement benefits on the tax return. All right. Social Security benefits are payments made under Title II of the Social Security Act. They include old age survivor and disability insurance, OASDI benefits. Social Security benefits include monthly retirement, survivor, and disability benefits. They do not include supplemental Social Security income or SSI. Certain government retirees who receive a pension from work are not covered by Social Security. Some portion of the Social Security benefits received may be taxable. Generally, if Social Security benefits are the only source of income, then the benefits are not taxable. In this instance, taxpayers may not be required to file a return. However, if the taxpayers are married, filing and live with their spouse at any time during the tax year, 85% of the benefits will be taxable. A lot of times you have older taxpayers who come in and they're not sure if their Social Security or railroad retirement benefits are taxable. And so they will come in and have you to complete a return just to see if any of their benefits are taxable. A lot of times, if the only benefits they have are Social Security, then we know that they are not required to file a return. But if they have any other type of income, such as if they worked a part job or anything of that nature, if they had any source of income, then yes, they will need to file a return to determine if a portion of their Social Security may be taxable. And so a return will need to be completed to determine if that other source of income made their Social Security taxable. All right. Railroad retirement benefits, or RRBs, are benefits paid to railroad employees working in jobs that are covered by the Railroad Retirement Act, or RRA. The RRA benefits have two components: Tier 1, which is Social Security equivalent benefits, and Tier 2, treated as a qualified employee plan. Tier 1 railroad retirement benefits are reported on Form RRB 1099, and the Tier 2 benefits are reported on.
They talking about Social Security.
Ms. Bridget, if you don't have a question, can you go on mute?
Retirement benefits. I don't remember how you said it. Let's show us.
Miss Bridget, can you go on mute?
The Grizz will play tonight, don't they? I'm gonna Google and see, because I know they play Wednesday. Yeah.
I don't understand how I'm being punished for something I don't have.
They play, what's the name of one?
Tier 1 railroad retirement benefits are reported on Form RRB 1099. The Tier 2 benefits are reported on the green Form RRB 1099R. These funds are discussed in the previous lesson on retirement income. On the screen, you see a screenshot of what the screen in your TaxSlayer software looks like. And so you can also, in your publication 4012, it also shows you how to enter the data in TaxSlayer. And so if you are if a taxpayer comes in with Social Security, this is what the software would look like if you have to enter the Social Security information into the software. This is what that would look like. Social Security benefits are reported on Form SSA 1099. Box 5 shows the amount of net benefits. Taxpayers who did not receive Form SSA 1099 or have misplaced it may be able to get an instant printout of benefits from their personal My Social Security account on the Social Security Administration website at ssa.gov, or taxpayers may call toll-free to request a benefit statement to be sent by mail. Social Security no longer provides benefit verification letters in their office. If they advise that they have or receive Social Security, they will need that document. You can't move on with the return if they don't have that documentation. They will need it. The taxable amount, if any, depends upon the filing status and any other reportable income, whether the benefits were the taxpayer's only source of income. If the benefits were the only source of income, the benefits are generally not taxable, as I stated, and the taxpayer need not file a federal income tax return. If the taxpayer received other income, the software will complete the Social Security benefits worksheet to calculate the taxable portion. And so you don't have to figure out whether or not it was taxable or not. The software will do that for you. And so all you need to do is to enter the information into the software, and the software will figure out what part is taxable and what part is not. All you need to do is to enter all the information that the taxpayer gives you, and the software will do the computation and calculation for you. Some taxpayers may have received a lump sum benefit payment. This payment could be for the current tax year and for prior tax years. Box 3 of the taxpayer's Form SSA 1099 or Form RRB 1099 will include the lump sum payment. The form will also show the year or years for which the payment is made. The additional information will be shown in description of amount in Box 3 of Form SSA 1099 or in boxes 7 through 9 on Form 1099. When figuring the taxable portion of Social Security benefits, 2 options are available for lump sum benefit payment. The first option allows the taxpayers to report the whole payment the year it was received. When the taxpayer chooses this option, complete the Social Security benefits worksheet as usual by including the entire lump sum payment as normal. The second option is to treat the payment as received in the earlier year or years. This is done by figuring whether any payment benefits is taxable based on the earlier year's income. Any part that is taxable is then added to any taxable benefits for the current year and included on Form 1040. The taxpayer can elect this method if it lowers benefits. Figuring the taxable benefits under the lump sum election method is in scope for the VITA TCE programs. Taxpayer will calculate the most beneficial option after you enter prior year tax return information. Prior year amounts will show in description block of Forms SSA 1099. And on your screen, it shows what that statement will look like that the taxpayer should provide for you. Any questions or concerns as it relates to Social Security income? Generally, if Social Security benefits were the taxpayer's only source of income, the benefits are not taxable, and the taxpayer does not need to file a federal income tax return. If the taxpayer receives Social Security benefits and other income, the Social Security benefits worksheet found in the Form 1040 instructions is completed by the software to calculate the taxable portion. When figuring the taxable portion of Social Security benefit, 2 options are available for lump sum benefit payment. The taxpayer may report the whole payment in the year it was received or treat the payment as received in the applicable earlier year or years to compute the amount of lump sum payment that is taxable in the current year.
I have a question about Social Security. You might not have covered it yet,
Okay,
take out money from their social security, do all that be taxable?
what was your question?
If they take out withholding from the social security, do all that automatically be taxable?
Take out withholding?
Yes,
So no, so if they have withholding taken out, that's just like you having withholding taken out of your W-2.
yes.
So it's not, so no, so the withholding is not taxable. That's just money they get back. That's just like you having withholding out of your W-2 or any other type of withholding.
Okay, so you just add that to the part where it's like you worked and when they take it out, but you don't use all their earnings, right?
What do you mean?
I'm saying when you doing it for their social security, you use a certain portion of that for the earnings. But then you, when they take withholding out, you count all of that, right?
So
I email you what I'm saying.
so no, so for okay, let me. So when you get ready to enter the information in TaxSlayer, you're going to enter what they paid into Social Security. So benefits. So box 3 is benefits that were paid, right? And so whatever they were paid for Social Security is what you're going to put. And so if they had, or box 5, I'm sorry. So whatever they received as benefits for Social Security, you're going to put, there's a box when you're in TaxSlayer, it's going to ask you what they received in 2024. And so you're gonna enter that. And then if they had in box 6, if they had withholding taken out, there's a box for that as well. So that's just like if they had a W-2. And so if they had if they had wages, but they also had if they also had withholding, it's two different amounts. It's the same thing. So is that what you're asking?
You say it's two different amounts, the amount they receive and then the amount they take out. That's what I'm asking.
Right. So
One-
it's,
You get them credit for all of it for the amount that they take out. Cause it's just like when you work, you put all of your withholding in one place and then your earnings go in another place, where the Social Security is the same way, right?
right. And so box 5, some of it may be taxable, some of it maybe not. And so if box 5, if none of it is taxable, they'll still get the credit for all of 6. Even if none of box 5 is taxable, they'll still get all of their credit for 6, even if none of box 5 is taxable. Is that what you're trying to ask?
Yes, okay, that's why.
Yeah. So even if none of box 5 is taxable, they'll still get all of their credit for box 6 because they had all of that withheld.
Okay, thank you.
So even if none of box 5 is taxable, I still get all of my credit for 6 because I had that withheld. So I had that withheld regardless. So whether 5 is taxable or not, I still had 6 withheld voluntarily.
Yeah, that's what I was asking. Okay,
Right.
thank you.
Mm-hmm.
Ms. Perk, I have a question.
Okay.
So I noticed that you said, when they don't have any income, didn't have a job, and they just have Social Security benefits, and they don't need to file. But is there times when they still want to file, or would they get anything?
No. So if I only had Social Security, and so if I had something in box 6, if I had withholding voluntarily, then yes, because I had withholding voluntarily. And so yes. So
Okay, so only if it's something in their box 6, that's the
yes.
only time they need to go ahead and file.
Yes. And now
Okay.
if they qualify for any other credits or anything, then yes. But if Social Security is their only income, there's nothing else they qualify. I don't have any other credits. I don't have any dependents or anything like that I may qualify for, then no. So if Social Security is the only income I have, and I know I don't qualify for any credits, then no. I mean, they could come in and file a return to see, but no. Now, but if I do have Social Security, I do have voluntary withholding coming out, then I would encourage them to file their return to at least get their withholding back. But other
Okay.
than that, no, if it's going to result in a zero return, then there's no reason to file a return. But you do have some taxpayers who know that the only income I have is Social Security, and they still file a return, a zero return, just to file a zero return, and that's fine. You know, I file returns for taxpayers like that because they're used to filing returns. And
Right. Okay. That was my question. Okay. Thank you.
Any other questions or concerns? All right. Other income is our next lesson. This lesson will help you determine other forms of income and how to report other sources of income. Part of this lesson is for all course levels, and part is only for the international level. The international part of this lesson will help you report income earned from worldwide sources. To do this, you need to be able to identify the type of income and, if reportable, convert it to the equivalent US dollar value of the foreign currency. That's something that you will probably never see in the VITA TCE program. This lesson will also cover the foreign earned income exclusion reported on Form 2555, foreign earned income, which also requires international certification. Again, something that you probably won't ever see in the VITA TCE program. At the end of this lesson, you will be able to determine other types of income and how to report other sources of income, determine whether a distribution from an ABLE or education savings account is taxable, determine whether a long-term care benefit must be reported or is taxable, determine whether a recovery of an expense that was deducted in a prior year is taxable, determine when canceled credit card debt is included in gross income on Form 1040, how to properly report income earned from worldwide sources, who is eligible for the foreign income exclusion, and how to calculate the excludable amount, Form 2555, foreign earned income. Income that does not have its own line on Form 1040 is generally reported on the Form 1040 Schedule 1. Some examples of that are prizes and awards, gambling winnings, including lotteries and raffles, jury duty pay, and that topic is covered in the adjustments to income lesson. Alaska Permanent Fund dividends, recovery of a deduction claimed in a prior year, and non-business credit card debt cancellation. In your publication 4012, there is an income quick reference guide that gives you Table A is examples of taxable income. Table B is example of non-taxable income. Other examples are cash for keys, and as well as the I think I said the Alaska Permanent Funds dividends. Some of these are things that you will never see come across your desk as a VITA TCE volunteer, but you know it's things that is covered in this lesson. Even if the taxpayer does not receive an income document from the payer, the taxpayer is required to report the income if it is taxable. It refers you to the income quick reference guide in the publication 4012, which is your volunteer research guide. Tab D, to confirm whether the income is taxable or non-taxable. If you are unsure about sources of other income, refers you to that tab D, and or your publication 17, which is your federal income tax, other income, or it refers you to your site coordinator for more information. It also refers you to your publication 4491 for details on other types of income, such as your health savings account. HSA distributions not used to pay or reimburse the taxpayer for qualified medical expenses are generally reported as additional income on Form 1040 Schedule 1. While this topic is not covered in this lesson, it will be covered in the adjustments to income lesson. Cancellation of debt. If a taxpayer has received Form 1099-C for canceled credit card debt and was solvent, all the canceled debt will be included on Form 1040 Other Income line. A debt includes any indebtedness for which a taxpayer is liable or which attaches to the taxpayer's property, such as auto loans, credit card debt, medical care, professional services, mortgages, and home equity loans. Generally, if a debt for which a taxpayer is personally liable is canceled or forgiven, the taxpayer must include the canceled amount in income. There is no income for canceled debt if the cancellation or forgiveness or debt is a gift or bequest. Generally, taxpayer must include all canceled amounts, even if less than $600 on the other income line on Form 1040. There is an insolvency determination worksheet in the publication 4491. Worldwide income. U.S. citizens and U.S. resident aliens are required to report worldwide income on a U.S. tax return regardless of where they live, and even if the income is taxed by the country in which it was earned. Filing requirements are the same as for U.S. citizens and U.S. resident aliens and apply whether income is from within or outside the U.S. U.S. citizens and U.S. resident aliens living abroad may be able to claim tax benefits such as the foreign earned income exclusion or the foreign tax credit. Income is treated the same on the return regardless of the country from which it is derived. Similar income earned inside or outside the U.S. is generally taxed in the same way on the return. Likewise, income earned in the U.S. and not taxed will be treated in the same way if earned outside the U.S. The lines on which the income is reported on the Form 1040 are the same whether the U.S. citizen or U.S. resident alien is living within or outside U.S. boundaries. Amounts reported on a U.S. return must be converted to U.S. dollars. And you use the rate in effect when the income was received. The average annual exchange rate can be used if the foreign income was received evenly throughout the year and the foreign exchange rate was relatively stable during the year. The monthly exchange rates can be used for foreign income earned evenly for one or more months, but not the whole year. Again, this is not something that I have ever seen in all the years that I have been doing the VITA TCE program. The foreign earned income exclusion. It allows qualified taxpayers to voluntarily exclude foreign earnings from taxable income. The amount is inflation, which is updated yearly. Does not apply to members of armed forces or the U.S. government employees. Taxpayers cannot claim the earned income credit or foreign tax credit if using this exclusion. The term foreign country does not include U.S. territories or possessions, and it refers you to the publication 54 for more details, and it is claimed using Form 2555. To be eligible to claim this exclusion, the taxpayer must demonstrate that his or her tax home is in a foreign country. They must meet a period of stay requirement that is either the bona fide residence test or the physical presence test. They must have income that qualifies as foreign earned income. For married couples, the requirement must be met separately for each person. And the taxpayers whose regular place of abode is in the US cannot be considered to have a foreign tax home and would not qualify for the exclusion. Again, it refers you to the publication 54 for more details. In order to meet that, they have to have a period of stay requirement. In order to do that, they must meet the bona fide residence test, which means they must have set up permanent quarters in a foreign country for an entire uninterrupted tax year, and also meet the physical presence test, which means taxpayers must be physically present in a foreign country 330 full days in 12 consecutive months. They must have qualifying income that must be earned, income for services performed in a foreign country that can include salary, wages, commission, or professional fees, or self-employment income. Types of income that would not qualify would be dividends, interest, capital gains, alimony, Social Security benefits, pensions, or annuities. This other income is reported on Form 2555 using TaxSlayer. The exclusion amount is calculated by TaxSlayer and entered as a negative number on Form 1040 other income line. Out of scope for this lesson is distributions from an ABLE account in which the funds were not fully used for qualified disability expenses. Distributions from educational savings account in which the funds were not used for qualified educational expenses, or distributions was more than the amount of the qualified expenses, and taxpayers who are insolvent and had debt canceled. Any questions regarding other income? All right. It looks like someone is trying to say something, but I can't understand what it is you're saying. I don't know what it is you're saying. You're showing up as Prospect Church. I don't know. Can you type it in the chat box what it is you're trying to say? Okay. We're gonna move on to adjustments to income. And if whoever that was that I think was trying to say anything, if you get your audio fixed, come back off mute or put it in the chat for me. This lesson covers the adjustments to income section of Form 1040, Schedule 1. Taxpayers can subtract certain expenses, payment, contributions, fees, etc. from their total income. The adjustment subtracted from total income on Form 1040 establish the adjusted gross income or AGI. Some items in the adjustments to income section are out of scope. This lesson will cover all in-scope topics. It refers you to the Volunteer Resource Guide, tab B, starting a return and filing status, or to irs.gov to view the Form 1040. At the end of this lesson, you will be able to identify which adjustments are within the scope of the VITA TCE program, calculate and accurately report the adjustments to income that are within the scope of the VITA TCE program. To identify the adjustments to income that taxpayers can claim, you will need to ask the taxpayers if they had the type of expenses listed on the adjustments to income section of Schedule 1. Some common adjustments to income you should ask taxpayers about. During the tax year, did the taxpayer or spouse pay qualified educator expenses, receive income from self-employment, have self-employment, health insurance, pay a penalty on early withdrawal of savings, have alimony, make contributions to an IRA or HSA, have student loan interest or pay student loan interest, have jury duty income repaid to an employer, or have a Form W-2 Box 12 Code H contributions to a Section 501c pension plan. Total income minus adjustments equal adjusted gross income or an AGI. Again, it refers you to the publication 4012, tab E, adjustments. Educator expenses. Eligible educators can deduct up to $300 of qualified expenses paid during the tax year. If both the taxpayer and spouse are eligible educators, they can deduct up to $600, but neither can deduct more than their own expenses up to $300. The deduction amount is indexed for inflation, so future maximum deduction amounts may be higher. If the taxpayer or spouse is an educator, probe a little deeper to see if they qualify for this adjustment. Ask questions such as, are you or your spouse a teacher, instructor, counselor, principal, or aide in school? What grade or grades do you teach? Must be K through 12. Were you employed for at least 900 hours during the school year, which is the minimum required hours? You don't have to, if you don't remember what the minimum or maximum amount is, you don't have to remember what that amount is. The software will take the minimum, we'll take the maximum. So if you put in $600, the software won't give $600 for the expense. It's only going to allow what that maximum is. So it won't $300. It's going to, so even if you put the wrong amount in, it is going to only give them what that maximum allowable expense is for this education expense. Expenses that qualify include books, supplies, equipment, other materials used in the classroom. Expenses that do not qualify, homeschooling, non-athletic supplies for physical education, supplies for health courses. And so if they are an educator, if they've taken this expense before, then they already know as a teacher what qualifies, what don't qualify, and most times they already know what the max expense is that they can take.
So I have a question.
Okay,
If you put both of them on there, they filing a joint return, that's when it'll get them the $600.
yes, if they are married filing joint, yes.
Uh-huh, okay.
Mhm. All right. Self-employed taxpayers can deduct a portion of their self-employment tax from their income. A portion of the self-employment tax is automatically calculated from Schedule FE. Self-employment health insurance deduction is in scope for returns without premium tax calculations. Self-employed taxpayers who report a net profit on Schedule C for the year may be able to deduct the cost of their health insurance paid as a deduction from their gross income. For an in-scope return, the health insurance policy can be either in the taxpayer's name, the spouse's name, if married filing joint, or the name of the business. Penalties for early withdrawal. Form 1099 INT, interest income, or Form 1099 OID, original issue document, document this penalty. The penalty amount is entered on the interest statement in TaxSlayer. And so once the taxpayer provides you with that statement, all you have to do is to ensure that you're reading all the boxes and enter that information in the applicable box in TaxSlayer. Alimony paid. Alimony payment subtracted from income by the payer, reported as income by the recipient, can be payments to the ex-spouse or payments to cover expenses for the ex-spouse, such as medical bills, housing costs. Do not confuse alimony payments with child support payments, which are not deductible. It refers you to publication 4012, tab E, adjustments, alimony requirements, the alimony chapter in publication 17, and publication 504, divorce or separated individuals. This is not something that's common in the VITA TCE program as well. You may or may not see it. I cannot tell you if I've seen alimony in my time in the VITA TCE program. I may have seen it once, but I cannot tell you this is something that's common. IRA contributions. Individual retirement arrangements, or IRAs, are personal saving plans that offer tax advantages to set aside money for retirement. This is something that is common. This section discusses traditional IRAs. A traditional IRA is any IRA that is not a Roth or simple IRA. It refers you to publication 590, individual retirement arrangements, for more information on all types of IRAs. Only contributions to traditional IRAs are deductible. Some of the features of a traditional IRA are taxpayers may be able to deduct some or all of their contributions to the IRA depending on circumstances. Generally, amounts in an IRA, including earnings and gains, are not taxed until distributed. Contributions may be eligible for the retirement savings contributions credit. Although contributions to a Roth IRA cannot be deducted, the taxpayer may be eligible for the retirement saving contributions credit, which is discussed in the lesson on miscellaneous credits. Taxpayers may contribute and deduct up to $7,000 or $8,000 if age 50 plus. Contributions cannot be more than the taxpayer's yearly compensation. Deductions can be phased out depending on the income or the modified adjusted gross income, filing status, and availability of employer-provided retirement plan. Find the IRA deduction worksheet in the Form 1040 instructions. To add IRA contributions, go to the Adjustments tab and click Begin on the IRA deduction line. Health Savings Account, or HSA. Review the taxpayer's intake, interview, and quality review sheet to see if the HSA box is checked. The taxpayer or spouse's Form W-2 will contain code W in box 12 for employer contributions. The taxpayer or spouse should have a Form 1099 SA with an X in the box showing distributions from an HSA. It refers you to publication 4012, tab E, Health Savings Account for contribution limits. Student loan interest. Generally, the smaller of $2,500 or the interest paid that year on a qualified student loan. Gradually phased out or eliminated based on the taxpayer filing status and modified adjusted gross income. Reported to the taxpayer on Form 1098E, Box 1. It refers you to publication 4012, tab E, Adjustments, Student Loan Interest Deduction at a Glance. See publication 970, Tax Benefits for Education. Refer to the Student Loan Deduction Worksheet from Form 1040 instructions. And again, you don't have to remember what that total amount is. All you have to do is to put in what the taxpayer advises. Even if it's over the 2,500, the software will take the max. And so all you have to, whatever the taxpayer gives, if that statement shows more than 2,500, the software is going to take what that max is. Any questions or concerns on adjustments to income? The lesson did not talk about jury duty pay turned over to the taxpayer's employer. If a taxpayer does have, if they had jury duty pay that they turn over to their employer, then they will have documentation as it relates to that. And you would just enter that into the software. There is a place for that to be entered, and they will documentation for that. If jury duty pay received by taxpayers is included in other income on Form 1040. And so sometimes if a taxpayer is paid, taxpayers are paid for jury duty. And sometimes if the employer pays them for jury duty, they will have to turn over what the state or pays them because the employer has already paid them. And so they will give them some sort of documentation at the end of the year. And so that is included in their wages or statements. And so they will have documentation for that. And there is somewhere in the software that is built in for that. And you would just have to put that into the software if they have that type of documentation. I've never seen that, but if they have anything like that, then you would just enter that into the software where it is applicable. All right. Any questions or concerns about anything that we have covered so far? All right. We have, I want to do standard deduction, itemized deductions before we get into credits. We'll do these two lessons. We'll take a break. We'll come back and do credits. And then we'll get into the certification. All right. If that's all right with you all. After completing this lesson on standard deductions and the itemized deduction lesson, you will be able to subtract the appropriate deduction. And if the taxpayer qualifies, the qualified business income deduction from the taxpayer's adjusted gross income or AGI to figure their taxable income. At the end of this lesson, you will be able to determine the standard deduction amount for most taxpayers, determine the standard deduction amount for taxpayers claimed as dependents, identify how taxable income and income tax are computed and reported, determine the amount of qualified business income deduction, if any. All right. So, in addition to the deductions covered in the adjustments lessons, there are additional deductions that are subtracted from a taxpayer's adjusted gross income, or AGI. They reduce the amount of income that is taxed. Most taxpayers have a choice of taking a standard deduction or itemizing their deductions. When taxpayers have a choice, they should use a type of deduction that results in the lower tax. You want to use interview techniques and interview tools discussed in earlier lessons to assist you in determining if the standard deduction will result in the largest possible deduction for the taxpayer. A standard deduction for most taxpayers is a set dollar amount based on the taxpayer's filing status. An increased standard deduction is available for taxpayers who are 65 or older or blind. There are limitations on the standard deduction for taxpayers who can be claimed as a dependent on someone else's return. The current year standard deduction amounts are included in your volunteer resource guide or your publication 4012 under tab F, deductions, and in the important changes lessons of this publication, which we discussed on Tuesday. The software will use the applicable standard deduction based on your interest in the software. And so that's why it's always important that the 13614C is discussed during the intake interview process, and is completed correctly, and it's discussed with the taxpayer, and you're having a discussion with your taxpayer during the input process to ensure that the filing status is correct, and that you know what the taxpayer, that what you're in that software or in that return is correct. All right. Taxpayers who cannot take standard deduction and must itemize are taxpayers who are filing as married filing separately and the spouse is itemized. We talked about this when we went through the filing status lesson. If a taxpayer is married filing separate and they itemize, so if the husband comes in and they sit across from you and he says that I am married filing separate and I'm itemizing, then that wife also has to file married filing separate, and she also has to itemize, even if she does not have enough to itemize. If that husband has already filed and he has already itemized, she has no choice but to itemize because he has already itemized. Even if she only has $10,000 worth of deductions, she still has to itemize because he has already filed his return and itemized. And so we have to make that clear when he is filing his return and he is filing married filing separate, that when she files her return, she has to itemize no matter what her amount of deductions are, because he is filing his as married filing separate and he is itemizing. Taxpayers who are also filing as non-resident or dual status aliens also must itemize. Standard deduction is automatically calculated based on entries in the basic information section. So be sure that you are completing that correctly when you are filing those returns. Itemized deduction allows taxpayers to reduce their taxable income based on specific personal expenses. If the total itemized deductions are greater than the standard deduction, it will result in a lower taxable income and lower tax. In general, taxpayers benefit from itemizing deductions if they have mortgage interest, very large unreimbursed medical or dental expenses, when compared to their income, state taxes, or other large expenses such as charitable contributions. Itemized deductions will be covered in the next lesson. Standard deduction is higher for a taxpayer or spouse 65 or older, or if one or both spouses are blind. This information is reported in the check boxes located on Form 1040 or Form 1040 SR. The more check boxes marked, the higher the standard deduction. Be sure to verify the taxpayer's and spouse's age and level of blindness as described. Taxpayers are entitled to they are considered to be 65 on the day before their 65th birthday. In other words, a person born on January the 1st is considered to be 65 on December the 31st of the previous year. It refers you to publication 4012 tab E, adjustment standard deduction chart for people 65 or older or who are blind chart as a guide to computing the standard deduction. Taxpayers can take the higher standard deduction if one spouse is 65 or older or is blind, and if taxpayers file a joint return or taxpayers file a separate return and can claim an exemption for the spouse. Taxpayers are entitled to a higher standard deduction if they are considered blind on the last day of the year and they do not itemize their deductions. A taxpayer who is not totally blind must have a certified statement from an eye doctor that the taxpayer cannot see better than 20/200 in the better eye with glasses or contact lenses, or the field of vision is not more than 20 degrees. If the eye condition is not likely to improve beyond these limits, the statement should include that fact. Taxpayers should keep the statement for their records. The standard deduction is generally lower for an individual who can be claimed as a dependent by another taxpayer. Taxpayers who can be claimed as a dependent must use the standard deduction worksheet for dependents to determine their standard deduction. The worksheet can be found in the Volunteer Resource Guide tab F, deductions, and the dependent standard deduction can be summarized. Form 13614C has a checkbox for a dependent being claimed by another taxpayer. Use Form 1040 instruction standard deduction worksheet to calculate the deduction. Standard deduction versus itemized. Examples of types of expenses that generally warrant itemizing deduction. Again, large out-of-pocket medical and dental expenses, state and local income taxes, sales tax, real estate taxes, and/or personal property taxes. Mortgage interest, gifts to charity, certain other miscellaneous deductions. If the taxpayer's expenses qualify, itemizing may be a better choice. Kiddie tax. For children under age 18 and certain older children, unearned income over a certain amount is taxed using the tax rates applicable to their parents. For this purpose, unearned income includes all taxable income other than earned income, such as taxable interest, ordinary dividends, capital gains, rents, royalties, etc. It also includes taxable Social Security benefits, pensions, and annuity income, taxable scholarship and fellowship grants not reported on Form W-2, unemployment compensation, alimony, and income received as the beneficiary of a trust. If the child's unearned income is more than the ceiling amount and the child is required to file a tax return, Form 8615 must be used to figure the child's tax. Form 8615 must be filed if the following are true. The child's unearned income was more than the ceiling amount. The child is required to file a return for the tax year. The child either was under age 18 at the end of the year, was age 18 at the end of the year and did not have earned income that was more than half his or her support, or was a full-time student at least age 19 and was under age 24 at the end of the tax year and did not have earned income that was more than half of the child's support. At least one of the child's parents was alive at the end of the tax year. the child does not file a joint return for the tax year. Qualified business income. For taxable years beginning after December 31st, 2017 and before January 1st, 2026, there is a deduction for pass-through businesses. Sole proprietors are categorized as pass-through businesses. A sole proprietor will be able to take up to 20% of qualified business income as a deduction on the tax return. The calculations on Schedule C and Schedule SC are not affected by the deduction. Taxable income is not reduced below zero by the 20% deduction. The 20% deduction is limited for higher incomes. The deduction will also be limited for specified service trade or businesses. The tax software computes the QBI deduction and completes Form 8995, Qualified Business Income Deduction Simplified Computation. Taxpayers will pass through business income from an entity on a Schedule K-1 income over the threshold amount or who require Form 8995A Qualified Business Income Deduction should be referred to a professional tax preparer. Refer to the important changes lesson for the threshold amount. Qualified business income is reduced by the deductible part of the self-employment tax, this self-employment health insurance deduction, and by contributions to certain qualified retirement plans. Based on the taxpayer interest, the software will compute the QBI if applicable. A separate worksheet is used to calculate tax for taxpayers with capital gains, qualifying dividends, and foreign earned income. Any questions or concerns about standard deduction and tax computation? Run through itemized deductions, and then I will let you go on a break. And then we will hop into credits. This lesson will assist you in determining if a taxpayer should itemize deductions. Generally, taxpayers should itemize if their total allowable deductions are higher than the standard deduction amount. At the end of this lesson, you will be able to determine if a taxpayer should itemize deductions, determine the type of expenses that qualify as itemized deductions, accurately report itemized deduction on Schedule A, explain the record keeping requirement for claiming charitable contributions. Itemized deductions are subtractions from a taxpayer's adjusted gross income, or AGI, that reduce the amount of income that is taxed. Most taxpayers have a choice of taking the standard deduction or itemizing deductions. Taxpayers should use the type of deduction that results in the lowest tax. Taxpayers who have a standard deduction of zero should itemize their deductions. Taxpayers who normally fall within this category are married filing a separate return and their spouse is itemizing, regardless of who files first. Filing a return for a short tax year due to a change in the annual accounting period, which is out of scope for the VITA TCE program. And considered to be a non-resident alien or dual status alien during the year. And not married to a U.S. citizen or resident at the end of the tax year. In general, taxpayers who have deductible mortgage interest, state taxes, charitable contributions, or a very large amount of unreimbursed medical dental expenses compared to their income would benefit from from itemizing their deductions. It refers you to publication 4012, tab A, deductions. TaxSlayer will automatically select the larger of itemized versus standard deduction. And if you are not sure, or if you or the taxpayer are not sure on whether or not they should itemize versus taking the standard deduction, if they have documents to determine whether or not they should itemize, you can enter the documents that they have, or the totals that they have, to see if they should itemize, and TaxSlayer will determine whether or not they should itemize. It'll kind of compare the two to figure out whether or not they should itemize, to kind of tell you whether or not they have enough to itemize, or whether or not the standard deduction is going to give them the bigger advantage. And so you can enter the information that they have into the software, and it'll give you a comparison of which one is going to give them the bigger advantage. And so you don't have to kind of figure it up on in your mind or on your hand or whatever that looks like, to determine which one is going to give them a bigger advantage. The software will do that for you. All right. Medical and dental expenses. Taxpayers can deduct only the amount of unreimbursed medical and dental expenses that exceeds 7.5% of their adjusted gross income. The standard mileage rate allowed for out-of-pocket expenses for a car when used for medical reasons can be found in the Volunteer Resource Guide, or your publication 4012 tab deductions. Taxpayers can also deduct parking fees and tolls. Qualified medical and dental expenses paid by the taxpayer can be included for the taxpayer, the spouse, and their dependents. Qualified medical and dental expenses paid by the taxpayer during the tax year can be included for dependents claimed at the time the medical service were provided, or at the time the expenses were paid. Individuals who could be the taxpayer's dependent, except they do not meet the gross income test, or they do not meet the joint return test, or the taxpayers or their spouse, if filing jointly, could be claimed as a dependent on someone else's return. It refers you to publication 4012 tab F and publication 502, medical and dental expenses, for more information on medical, dental, or other expenses. Taxes that may be deductible. Taxpayers can deduct certain taxes if they itemize. To be deductible, the tax must have been imposed on and paid by the taxpayer during the current tax year. Taxes that are deductible include state and local income taxes. This include withheld taxes, estimated tax payments, or other tax payments, such as prior year state or local income tax refunds that the taxpayers chose to credit to their estimated tax for the following year. Do not include penalties or interest. Sales tax, real estate taxes, which may be reported on Form 1098, mortgage interest statement, or a similar statement from the mortgage holder. Some real estate taxes or charges that may be included on the real estate tax bill are not deductible. Personal properties taxes, the state and local personal property taxes paid, but only if the taxes were based on value alone and were imposed on a yearly basis. It refers you to publication 17, which taxes can you deduct table, for more information. Interest paid. Certain type of interest payments qualify as itemized deduction. Home mortgage interest, points, and investment interest can be deducted on Schedule A. Investment interest is outside the scope of the VITA TCE program, and taxes with investment interest should be referred to a professional tax preparer. It refers you to the flow charts in publication 17 on is my home mortgage interest fully deductible. Gifts to charity. Taxpayers may deduct charitable contributions, donations, or gifts to qualified organizations. Exempt organizations select checked is an online tool for searching for organizations that are eligible to receive tax deductible charitable contributions. Taxpayers are required to keep receipts and records of all contributions. Again, it refers you to publication 17 and your publication 4012 for more information. Miscellaneous deductions. Miscellaneous itemized deductions include gambling losses and work-related expenses for disabled individuals. As it relates to gambling losses, a taxpayer can only take gambling losses up to the amount of winnings. All itemized deductions subject to the 2% of AGI limitations are not allowed through the end of 2025. This include employee business expenses. Again, it refers you to your publication 17 and your publication 4012. Out of scope for this lesson is casualty and theft losses, investment interest, Form 1098C, contributions of motor vehicles, boats and airplanes, taxpayers affected by limits on charitable deductions, taxpayers file Form 8283 to report non-cash contributions of more than $500, taxpayers donating property that was previously depreciated, taxpayers donating capital gain property, repayment of income of $3,000 or more, loss of termination of an annuity by a deceased annuitant. Any questions or concerns as it relates to itemized deductions? All right. I want to give you a few minutes for a break. We have a few lessons to cover on credits that I want to be able to go over. I want to be able to go over our credits lessons before we hop into the certification. I want to be able to go over at least one of the scenarios, input one of the scenarios with you all. And so let's take at least a 10-minute break if you all need it. And so we can hop back into the credits lessons, and then let's go into the certification. All right. Is that good with you all?
Yes.
Okay.
Yes.
So let's take about 10 minutes, and then we'll come back and hop right into the child independent care credit. And so that we can go into the advanced certification. All right, I don't know how long it's been, but if everyone is back, let's go ahead and get started. Credit for child independent care expenses. I won't spend a whole lot of time on the credits unless I need to. If you have any questions or concerns, if I go too fast, please stop me. I want to get into the certification. And so if I need to slow down, if I need to answer any questions, please stop me. All right. This lesson covers the credit for child independent care expenses. Some taxpayers may not be aware of this credit. Your time and effort may result in a lower tax for the taxpayers. This credit is calculated using the Form 2441 child independent care expenses. Please don't confuse this credit with the child tax credit. They are two separate credits. This credit is for childcare. So if a taxpayer pays for any childcare expenses before and after school care, if they pay for their child to go to summer care or anything like that, summer camp or anything like that, then they may or may not qualify for this credit. And so at the end of this lesson, you will be able to determine if a taxpayer is eligible for this credit and be able to calculate the amount of this credit. As we know, the software does all the computation and calculation. As long as you input the necessary information in the right place, the software will do all the calculation and computation. This is a non-refundable credit. The difference between a refundable and non-refundable credit. A non-refundable credit is a dollar for dollar reduction of the tax liability. A non-refundable credit can only reduce the tax liability to zero. A refundable credit can reduce the tax liability and result in a refund to the taxpayer. Again, the software will calculate these credits, so it's nothing you need to figure out. All you need to do is to enter the information into the software, and the software will do all the work for you. This credit is available to eligible taxpayers as a portion of their child independent care expenses. The credit may be claimed by taxpayers who, in order to work or look for work, pay someone to take care of their qualifying person. A qualifying person is a qualifying child under the age of 13, a spouse who is incapable of self-care, a dependent who is incapable of self-care. The meaning of incapable of self-care is not the same as permanently and totally disabled. Persons who can't dress, clean, or feed themselves because of physical or mental problems are considered not able to care for themselves. Also, persons who must have constant attention to prevent them from injuring themselves or others are considered not able to care for themselves. The credit can range from 20% to 35% of a taxpayer's qualifying child or dependent care expenses. Taxpayer may be able to exclude employer-provided dependent care benefits from income. Form W-2 Box 10 shows dependent care benefits from employers. You want to use publication 4012, tab G, non-refundable credits, credit for child independent care expenses, screening sheet to determine if a taxpayer can claim the credit. There are 5 eligibility tests to qualify for the credit. Qualifying person test, earned income test, work-related expense test, joint return test, provider identification test. Keep in mind that the taxpayer must pass all 5 of the tests to qualify for the credit. The qualifying person test, a qualifying child who is a taxpayer's dependent and under age 13 when the care was provided. If the child is being claimed as a dependent by the non-custodial parent under the special rules for children of divorced and separated parent, only the custodial parent may treat the child as a qualifying person for this credit. The taxpayer must both have earned income during the year. Earned income include wages, salaries, tips, other taxable employee compensation, net earnings from self-employment, strike benefits, disability pay reported as wages. Again, the 5 eligibility tests are qualifying person test, earned income test, work-related expense test, joint return test, provider identification test. In order for the person to receive this credit, the provider they must have that provider information. They must have the care provider's name, address, and taxpayer identification number. That information is required. If they come in and they explain that they paid for childcare expenses, they have the amount they paid, but they do not have who the child went to, that person's name, address, and taxpayer identification number, then they don't qualify to receive that credit. They must have that provider's information. In order to determine the amount of credit, it is claimed on the Form 2441, Child and Dependent Care Expenses. That form is divided into 3 parts. Part 1 is for general information about the care provider. It's going to ask for that provider's name, address, and that TIN, whether it's a social security number or an employee identification number. Part 2 is where the credit for child and dependent care expenses is calculated, how much that taxpayer paid. Part 3 is where the employer provided dependent care benefits are reported. The taxpayer's child and dependent care expenses are subject to an earned income limit. You want to always double check your entries. All entries need to be double checked. Make sure the Form 2441 Part 3 is completed if the taxpayer's Form W-2 shows an amount in box 10. Verify the Form 13614C shows box for child independent care is checked. Any questions as it relates to child independent care expenses? Always verify, always explain to the taxpayer that even if they pay $8,000 for daycare, they are not going to receive $8,000. They are only going to receive 20 to 35% of what they paid. They don't receive all that money back. They must satisfy 5 eligibility tests in order to qualify for their credit. Their credit is calculated and reported on Form 2441, but they must have all their related information as it relates to the provider that provided the services for that child. Any questions or concerns as it relates to this credit? All right. We moving right along. Education credit is another common credit that you are going to see. This lesson covers tax credits available to help the taxpayer offset the cost of higher education by reducing the amount of income tax. This lesson suggests program questions you can ask based on the intake and interview sheet, the volunteer resource guide, tab J, education benefits, and on the rules for claiming education credit. Your publication 4012 also have aids that you can refer to as it relates to the education credit. If there is a comparison of education credits chart that you can refer to if you need assistance as it relates to the education credit. At the end of this lesson, you will be able to determine who qualifies for education credit and determine which credit the taxpayer can claim. Education credit are amounts that will reduce the amount of tax due. The amount is based on qualified education expenses that the taxpayer paid during the year. There are 2 different education credits, the American Opportunity Credit and the Lifetime Learning Credit. The American Opportunity Credit allows 40% of the credit to be refundable. There are general rules that apply to these credits as well as specific rules for each credit. For an overview of the various education tax benefits, review the Volunteer Resource Guide, tab J, Education Benefits, highlights of education tax benefits. Taxpayers can take education credit for themselves, their spouse, and or dependents claimed on the tax return, who were enrolled at or attended an eligible post-secondary educational institution during the tax year. The law requires that the student must generally receive a Form 1098-T tuition statement in order for the taxpayers to claim the education credit. However, if the student's educational institution is not required to furnish a Form 1098-T, the taxpayer may claim a credit if the student does not receive a Form 1098-T. The student is required to provide the information that would otherwise be included on the Form 1098-T. Review the dependent section of the intake and interview sheet for children who are shown as full-time students. Ask the taxpayer if there are education expenses. Disqualifying conditions include if a taxpayer can be claimed as a dependent on someone else's tax return, files as married filing separately, has an AGI above the limit for the taxpayer's filing status, was a non-resident alien for any part of the tax year and did not elect to be treated as a resident alien for tax purposes. In order to be eligible to claim the student for a student's to claim the credit for a student's qualified expenses, the taxpayer must claim the student as a dependent. Expenses must have been paid to an eligible educational institution. There is a link in order to search the databases for all accredited schools. The school has to be accredited in order for the taxpayer to be able to claim that credit. Qualifying expenses. Qualified education expenses are tuition and certain related expenses required for enrollment or attendance at an eligible educational institution. Qualified education expenses include non-academic fees such as student activity fees, athletic fees, or other expenses unrelated to the academic course of institution that must be paid to the institution as a condition of enrollment or attendance. However, for the American Opportunity Credit, the definition for certain related expenses is different for the Lifetime Learning Credit. Asked to see such documentation such as Form 1098-T issued by the school. The taxpayer can add other expenses that qualify for education credits, such as books or supplies not purchased through the school account. Necessary proof of expenses include such documents as receipts and the Form 1098-T tuition statement issued by the school. Qualified expenses must be reduced by the amount of any tax-free educational assistance taxpayers receive. Taxpayers can claim payments that were prepaid for the academic period that begins in the first 3 months of the next year. Which expenses do not qualify? Do not include expenses such as room and board, insurance, medical expenses, transportation costs, or other similar personal, living, or family expenses. Any course of instruction or other educational involving sports, games, or hobbies, unless the course is part of the student's degree program. Or helps the student to acquire or improve job skills. If expenses or scholarships are adjusted in a later year, the school will report in box 4 or box 6 of Form 1098-T. For the American Opportunity Tax Credit, that credit is available for the first 4 years of college per eligible student. The credit covers 100% of the first $2,000 and 25% of the second $2,000 of eligible expenses, up to the amount of tax or a maximum of $2,500. 40% of the credit is a refundable credit. You don't have to figure any of this up. Again, the software does all the calculation and computation for you. The Lifetime Learning Credit. The credit is 20% of the first $10,000 of eligible expenses, up to the amount of tax or a maximum of $2,000. This credit is non-refundable. Eligible students are not required to be enrolled at least half-time or in a degree program, and a felony drug conviction is not a disqualification. It refers you to the publication 4012, tab J, Education Benefits, Education Credits for Basic Requirements. Taxpayers cannot receive multiple benefits for the same student. Taxpayers have several options for claiming education expenses, the American Opportunity Credit or the Lifetime Learning. They can also report as business expenses on Schedule C. So students can choose which one they want to choose as the credit, but they can't choose both. Again, you can use the comparison of education credit chart located in your publication 4012 under tab J to see which one is going to give you the better option. Again, you don't have to determine the amount of credit. The software will do the computation or calculation for you. All you have to do is to enter the amount and answer the questions in the software to determine the calculation of the credit. Out of scope is taxpayers who must repay or recapture part or all of an education credit claimed in a prior year. Any questions or concerns as it relates to the education credit? Child tax credit and credit for other dependents is the next lesson that we will cover. The child tax credit is unique because if a taxpayer cannot benefit from the non-refundable credit, the taxpayer may qualify for the refundable additional child tax credit on Schedule 8812, credits for qualifying children and other dependents. In this lesson, we will learn about both credits and their relationship to each other. Some taxpayers may not be aware of these credits. Your time, effort, and understanding of this credit may result in a lower tax for the taxpayer. The child tax credit, credit for other dependents, and the additional child tax credit are entered on Form 1040. The intake and interview sheet, along with the volunteer resource guide, tab G, non-refundable credits are critical tools needed to determine eligibility for the credit. Do not confuse this credit with the child independent care credit. At the end of this lesson, you will be able to determine the taxpayer eligibility for the credit, determine which taxpayer can claim the credit. The child tax credit, or the CTC, is a non-refundable credit that allows taxpayers to claim a tax credit of up to $2,000 per qualifying child, which reduces their tax liability. The additional child tax credit, taxpayers who are not able to claim the full amount of the child tax credit may be able to take the refundable additional child tax credit, or the ACTC. Completing Schedule 8812 may result in a refund even if the taxpayer doesn't owe any tax. Again, you don't have to compute or calculate either of these. The software does all the calculation or work for you. To be eligible to claim the child tax credit, the taxpayer must have at least one qualifying child. If taxpayers claim the child tax credit or additional child tax credit but are not eligible for the credit, they can be banned from claiming the credit for either 2 or 10 years. Refer to disallowance of credit, certain credits in your 4012 to determine if Form 8862, information to claim certain credits after disallowance, must be filed. To be a qualifying child for the child tax credit, the child must be the taxpayer's dependent. There are special rules for children of divorced or separated parents, as well as children of parents who live apart. The amount of the credit may be reduced if the taxpayer's modified adjusted income is above the limits for the taxpayer's filing status. Tax liability less the majority of the non-refundable credit is less than the maximum child tax credit. To determine whether a child meets the criteria of a qualifying child for the child tax credit or additional child tax credit, use the interview techniques and tools discussed in earlier lessons. Begin by reviewing and completing the marital status and household information section of the taxpayer's intake and interview sheet. Verify that the child is under age 17 on December 31st of the tax year. Live with the taxpayer for more than 6 months of the year. Did not provide over half of his or her own support. Meets the relationship criteria. Is a U.S. citizen, U.S. national, or resident of the United States. Has a valid Social Security number. Schedule 8812 is the only document used to calculate the credit, replacing the worksheets in publication 972. Again, TaxSlayer will automatically calculate the credit provided you have correctly completed Form 1040 through the Retirement Savings Contribution Credit line in Part 1 of the Form 5695 and Schedule R. Taxpayers who do not get the full $2,000 of the child tax credit may qualify for the refundable additional child tax credit. For taxpayers who earned income over $2,500, the credit is based on the lesser of 15% of the taxpayer's earned income that is more than $2,500, or the amount of unused child tax credit. Credit for other dependents. There is a $500 credit for other dependents who do not qualify for the $2,000 child tax credit. Taxpayers cannot claim the credit for themselves or a spouse if married filing jointly. Taxpayers that exceed the modified adjusted gross income limits for the credit for other dependents will not get the full amount of the credit. The tax software automatically applies the modified adjusted gross income limits and phase out based on the filing status of the taxpayer. The $500 non-refundable credit covers dependents who don't qualify for the child tax credit, such as children who are age 17 and above, or dependents with other relationships, such as elderly parents. Taxpayers, again, cannot claim the credit for themselves. A thorough interview and accurate entries on the intake and interview sheet are critical to correctly identify all eligible children. And you want to note any unusual situations on the intake and interview sheet to avoid common errors. Any questions or concerns as it relates to the child tax credit and credits for other dependents? Child tax credit allows taxpayers to claim a tax credit of up to $2,000 per child. When the dependent is not eligible for the child tax credit, they may be eligible for the non-refundable $500 credit for other dependents. The qualifying child must have a valid SSN by the due date of the return, including extensions. To claim the credit for other dependents, the dependent must have a valid identification number. That can be an ATN, which is the adopted taxpayer identification number, an ITN, or an SSN by the due date of the return, including extensions. Miscellaneous credits is the next lesson. This lesson provides the information you will need to be able to prepare a return with certain other non-refundable credits. At the end of this lesson, you will be able to determine if a taxpayer qualifies for the Retirement Savings Contributions Credit and accurately complete Form 8880, credit for qualified retirement savings contributions. Recognize if a taxpayer qualifies for the Energy Efficient Home Improvement Credit. Calculate the credit for the elderly or the disabled by completing Form 1040, Schedule R, credit for the elderly or the disabled. Use the information from the intake and interview sheet along with the documents provided by the taxpayer to determine eligibility for these credits. In an earlier lesson, you learned the difference between a non-refundable credit and a refundable credit. A non-refundable credit can only reduce the tax liability to zero. All the credits discussed in this lesson are non-refundable credits. Generally, non-refundable credits are applied against federal tax in the order they are listed on Form 1040, Schedule 3 non-refundable credits. The software will calculate these credits, but the correct information must be entered. The volunteer tax preparer must make the correct determinations by using the intake and interview sheet and resource materials. The retirement savings contribution credit is a non-refundable credit eligible taxpayers may claim if they made a qualifying contribution to a retirement plan. If the contribution is tax deductible, such as a traditional IRA, the taxpayer receives the benefit of the tax deduction and a tax credit. This is considered a double benefit and is rarely allowed. Contributions to non-deductible accounts, such as Roth IRAs, can qualify the taxpayer for the credit as well. The credit is calculated on Form 8880, Credit for Qualified Retirement Savings Contributions. Generally, an individual who made a voluntary contributions to a retirement account is at least 18 years of age, not a dependent, and not a full-time student, may be eligible to claim this credit if their income is not too high. It refers you to the Volunteer Resource Guide, tab G, non-refundable credits, to review the retirement savings contribution credit screening sheet for the qualifications. You can check the taxpayer's Form W-2 for amounts listed in box 12 and 14. Or you can refer to the Form W-2 instructions for a complete list of box 12 codes. Distributions received during a testing period may reduce eligible contributions. Credit for the elderly or the disabled are calculated on Schedule R and reported on Form 1040, Schedule 3. Qualified individuals must be age 65 or older at the end of the tax year or under age 65, retired on permanent and total disability. It refers you to publication 4012, non-refundable credits tab, credit for elderly or disabled. There is a decision tree to help you or to give you more information as it relates to this credit. Mortgage interest credit is another credit. Mortgage credit certificates or MCCs issued under a state or local government program may qualify for a non-refundable credit for mortgage interest paid. This type of credit is out of scope for the VITA TCE program. Residential energy credits. Individuals who purchase qualified energy efficient improvements for their main home may be allowed non-refundable tax credits. There are two types of residential energy credits. The residential clean energy credit, Form 5695 residential energy credits, Part 1, that's out of scope for the VITA TCE program. Energy efficient home improvement credit, that's Part 2 of the Form 5695. This provision is extended through 2032. The credit is available for certain qualified energy efficient improvements or residential energy property costs. It refers you to publication 4491 for more information as it relates to those credits. Non-refundable credits are reported on the applicable lines of Form 1040 Schedule 3. Credits cannot exceed taxpayers' federal income tax. It refers you to publication 4012. You don't have to know the limits or limitation as it refers to anything, any credits, any deductions, or anything as it relates to that. The software will apply any limits to credits, deductions, or anything. The software automatically applies those limitations. Out of scope is the mortgage interest credit. Any questions or concerns as it relates to miscellaneous credits? The last thing that I want to go over or discuss before we hop into the practice lab or the advanced scenario is the premium tax credit. In this lesson, you will learn how to determine if taxpayers are eligible to receive the premium tax credit. At the end of this course, you will be able to determine the eligibility for the premium tax credit, calculate the PTC or the premium tax credit, and report the taxpayer's PTC on the tax return. These forms may indicate the taxpayer or a member of the tax household had healthcare insurance from the marketplace or through an employer, but volunteers should rely primarily on their interview with the taxpayer. This is something that's common. The 1095A, you may not see a lot of it, but you will see it. If the taxpayer had insurance through the marketplace, they must have that 1095A. Returns will be rejected if the taxpayers had insurance through the marketplace and do not bring their 1095A. The software, the return has to have that 1095A. The return has to include that 1095A or it will be rejected. Taxpayers may choose to have advanced payments of the premium tax credit, the APTC, or get all of the benefit of the PTC when they claim the credit. 1095A, taxpayers who purchase health insurance from the marketplace will receive this form. They have to reconcile on their return that information, and if they do not, the return is going to reject because they have to reconcile that information at the end of the year. Federal poverty line, or the FPL, states an income amount considered poverty level for the year and is adjusted for family size. There are FPLs for 48 states and DC, Hawaii, and Alaska. For tax year 2024, residents of one of the 48 contiguous states or Washington, D.C., 100% of FPL is $14,580 for one individual, $19,720 for a family of two, $30,000 for a family of four. You can review that information in your publication 4012. In order to claim the PTC or the premium tax credit, the Form 8962 is used. And it must be filed with the tax return if the APTC was paid on the taxpayer's behalf, or if the APTC was not paid, but the taxpayer wishes to take the PTC. You should complete the Form 8962 only for health insurance coverage in a qualified health plan purchased through the marketplace. If they had health insurance through their employer, if they had Medicaid, Medicare, or any of that type of insurance, is not needed. But if they state they had health insurance through the marketplace, then that 1095A and that 8962 is required. Certain circumstances, such as a divorce, results in a shared policy, and that is out of scope for the VITA program, and that's not something that we can complete. You'll have to refer them to a paid preparer or somewhere else, but that's not something that VITA can complete for them. Form 8962, premium tax credit, is used to calculate the credit and reconcile the advance payment of the credit. The second lowest cost silver plan, or the SLCSP premium, is determined by the marketplace and included on the Form 1095A. Taxpayers can use the information on Form 1095A to compute their premium tax credit on their tax return and to reconcile their advance credit payments. Changes in circumstances that can affect the amount of the actual premium tax credit include increases or decreases in household income, marriage, divorce, birth, or adoption of a child, any other changes in their household composition or makeup, gaining or losing eligibility for government-sponsored or employer-sponsored health care, and a change in their address. So if they made any type of change from the time they received or anytime they purchased that health insurance to the time they filed that tax return, then it's going to make a change in that insurance. It refers you to the publication 4491 appendix for practice exercises as it relates to the premium tax credit. For more information on how to learn more information on the premium tax credit. Any questions or concerns as it relates to the Affordable Care Act or the premium tax credit? It's 8:30. I want to be able to take you all through at least one of at least one of the scenarios in the advanced certification, so you all would know what that looks like. There's a question that says, do the tax rules calculate the refundable or non-refundable credits first? So when you go through when you are inputting the return, it's going to calculate all of that for you. The software is going to calculate the order that it should be put in. And so yes, so it's not going to allow you to take the tax below zero. So it's going to do all the calculation, the computation in the correct order that it needs to be put in. So it's not going to allow you to do anything out of order. It's going to do what it needs to do in the correct order that it needs to be done in. I think that's Katrina that asked that question. So it's going to do what it needs to do in the order that it needs to be done in. So it's not going to allow you to take the tax liability below zero out of order. It's going to calculate everything that it needs to do in order. And I kind of show you that when I input a scenario.
Are you gonna take us to TaxSlayer to do it, or you just gonna show us an example?
I want to take you through the practice lab. Can you all see my screen?
Yes.
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 I I don't know if I'll be able to split my screen. I'm going to see if I can. Give me 1 second. Hold on. See if I can. Are you all seeing the 6744, or what are you all seeing on my screen?
Six, 7, 4, 4.
Okay. Okay. So I think so the 6744 is what you use is this the what you use for your certification. So to begin your advance, you don't have to. The first 6 scenarios of your advance do not require you to prepare a return. So we'll come back and go through the first 6 scenarios, answer those questions. All right. I want to go to scenario 7. That one requires us to input a return. So I want to go to scenario 7 to show you all how to and go to the practice lab in order to show you all how to enter that information into the practice lab. I want to see if I can split my screen. I don't know how to do it. I'm not tech savvy on a Mac. So in your in your form 6744, I always call it a publication. It's not, it's a form 6744. If you are following along on page 81, advanced scenario 7 is Vincent and Faith Hunter. It says using your tax software, complete the tax return, including Form 1040 and all appropriate forms. So when you get ready, so is anyone familiar with the practice lab? I think I showed some of you all the practice lab. Are you seeing the, let me go back. This is the practice lab. Are you all seeing the practice lab on your screen?
Yes.
Okay. I think I showed you all how to get to the practice lab on Tuesday. If any of you all are following along.
Can you show me again how to get to the practice?
I can. I absolutely can.
Thank you.
And so, yes. And so you will start from your Link and Learn landing page. See if it'll start me back. And so when you initially start at your Link Learn landing page, at the very bottom under quick links, you have a link for practice lab. It won't start me back. And so when you first click, it should take you to the very beginning of your practice lab. For whatever reason, it won't take me there. But normally if you click the under your practice lab, it should take you there. But for whatever reason, it won't take me there. And so you should have either a login or create an account. And so if you have never created an account, you are going to create an account, or you will have to create a username, password, and all of that. Your password has to be a minimum of 15 characters.
Miss Rucker, are you still talking?
Oh, no, I was giving you all a chance to log in.
Oh, okay. I'm sorry. I thought I had got lost or
Oh, no.
frozen. Okay.
I'm trying to multitask. And so once you all have created an account or logged in or whatever it is that you all need to do, and then it should bring you here.
Are you wanting us to log in now, or are you giving a demo?
If you all are wanting to follow me, then yes, you can log in. If not, then no, you don't have to.
Ms. Rucker, are we using TextLabProOnline.com? Is that what we using?
I'm sorry.
So what we typing in to get to where you are? TextLabProOnlineVita.com? Or just Vita TextLab
No,
Pro?
so you should be going to Link Learn.
So we type in Link Learn, not TextLab Pro.
Yeah, so you should be going to linklearncertification.com.
Okay.
That should take you to this landing page. It should take you, so you should be going to linklearncertification.com. That should be taking you to your Vital TCE landing page. And so if you don't have to do that at this, and I can actually put the link in the. I put it in the chat. Okay. And so if you all are not trying to follow me, then this is the practice lab. The practice lab is the exact replica of TaxSlayer. It is, so when you go through and you practice in the practice lab, is the exact software that you will be using as a Vital volunteer. And
Could
so
you give us the temporary password?
for the practice lab.
Yes,
And so
ma'am.
when you go to it's Train Pro Web, all one word.
Yes.
Train Pro Web, all one word, all caps. That's to get into the practice, the practice lab, and then you have to do your own username, password. And so when you get into your form 6744, it gives you the Social Security cards. It gives you all the income and wage documents. that you need. And so anytime you see a social security card, it gives you the first 5 numbers. Anywhere you see an X, you have to make up the numbers. And so like for Vincent Hunter, it gives you 41600. And so the last 4 digits you're going to make up. I always use 1, 2, 3, 4, 4, 5, 6, 7, whatever those 4 digits are, you're going to make up yourself. So anywhere you see a X, is numbers you have to make up. And for state, it's always YS. That means your state, your zip. You put in all that information. So anywhere you see YS is your state, your zip. Anywhere you see X's are numbers you have to make up. So anywhere in these documents you see X's are numbers that you're going to have to, your city, your state, zip, you fill in that. Anywhere you see X's, you fill in those numbers. All right. So when you are going through your certification, you'll have to read the scenario to figure out what the filing status is, what the entity information is, all of that. It gives you your 13614C in order to know what the information is as it relates to Vincent. It says Vincent is a 5th grade teacher. Vincent and Faith are married and choose to file married filing joint. So we know that the filing status is married filing joint.
Excuse me, can you hear me?
Uh-huh.
I apologize, but I just now got into the Lincoln Learn website,
Mm-hmm.
but I had previously logged in here. I may have logged in improperly.
Mm-hmm.
Where are you in? I'm at the central on the homepage, right?
Oh, I'm in the practice lab.
How do I get there from here?
You're here?
No, I'm where it says take certification test.
Oh, so you don't have to be signed in order to go to the practice lab. When you first log into when you first go to Lincoln Learn, under so you can log out under quick links, the practice lab is there.
Okay, 1 moment. I found it. Thank you.
Mm-hmm. we won't have a chance to go through the entire the input of this entire scenario. So is there anything that is it anything that I can show you all? Is it, or did you all want to answer the scenarios that don't require input? What is it that we can go through in the last few minutes that we have?
I don't know. Maybe she could go through.
Guess we'll do the questions. I guess we can do the questions because we have to have all the information on the form.
Have you all had a chance to go through the 6744?
I haven't. I haven't.
Okay. So can you all see my screen? Okay. So the advanced scenario starts on the advanced scenario starts on page 75. The first 6 scenarios do not require you to prepare a return. So we can, I want to be mindful of your time, but we can go through, we can go through we can go at least go through the first scenarios because you don't have to prepare a return. And so we can go through these questions, that you all may be able to answer. All right, you all want to do that?
Yes.
All right. So, this one says Sharon's husband, Daniel. And so be mindful, this is your advanced scenario. So if you have a form 674, go to page 75. If not, you may want to write these down because this is your advanced scenario. All right.
She had one child. She would claim this dependent.
So this is scenario 1. This is Sharon Smith. So it says Sharon's husband, Daniel, moved out of their home in February of 2022. Sharon has had no contact with Daniel since he moved out. Sharon and Daniel are not legally separated. Sharon has one child, Leah, age 10. She will claim Leah as a dependent on her 2024 tax return. Sharon is 31 years old. Sharon earned $44,500 in wages and received $50 of interest. Sharon had lottery winnings of $2,000, reported on Form W-2G. Sharon paid all the costs of keeping up her home. She provided over half of the support for Leah. They are all U.S. citizens and had valid Social Security numbers. They live in the U.S. all year. Sharon qualifies for head of household filing status. Is that true or false? Or false?
True.
True. Yeah, so.
That is correct. That's true.
Who qualifies to claim the earned income?
Number 2 says, who qualifies to claim the earned income credit for Leah? A is Sharon, B is Daniel, both Sharon and Daniel, neither Sharon nor Daniel.
Sharon.
That's correct. Sharon, A. Sharon is required to report her lottery winnings as income on her federal tax return. Is that true or false?
It's true.
True.
That's correct. Number 3 is A. That's true. Number 2 is for Jeff and Jane Spring. Jeff and Jane are married and want to file a joint return. Jeff is a U.S. citizen and has a valid Social Security number. Jane is a resident alien and has an I-10. They reside in the United States all year with their children. Jeff and Jane have 2 children, Joan age 7 and Jim age 15. Joan and Jim are U.S. citizens and have valid Social Security numbers. Jeff earned $23,000 in wages. Jane earned $21,000 in wages. In order to work, the Springs paid $2,000 to their son, Jim, to care for Joan after school. Jeff and Jane provided all of their support for their 2 children. What is the maximum amount Jeff and Jane are eligible to claim for the child tax credit?
Is it 6,000 since they got 2 children? 17.
I think it's 4.
For the child tax credit?
I have to see the thing. I don't know. I need to see the table.
Big.
Year is it?
$2,000.
Each child, if they got 2, they get 6,000.
That's probably the maximum.
It's B. It's 4,000. It's $2,000. It's $2,000 per child for the child tax credit. So it's B. The answer is B. $4,000.
I don't remember that.
The Springs, it said number 5 says the Springs qualify for the child independent care credit. Is that true or false?
True.
For the child independent care credit? What is the child independent care credit?
Oh, no.
I don't know. It's what they, I don't know the amount.
For the child care after school?
So would they qualify for that?
Yes,
Why?
because they had to pay $2,000 to go to work for child care after school.
But who did they pay it to?
Yeah, it's not a
Springs.
certified provider.
Paid it
That's
to
correct.
Jim. He's not, that's right. He's not a qualified provider.
That's correct. So the answer would be
Okay.
False.
false.
Because we don't have the information.
So number 5 is B. Scenario 3 says Mary Wood is age 58. She's single. She earned $51,000 and was enrolled the entire year in a high deductible health plan with self-only coverage. During the year, Mary contributed $2,000 to her health savings account, HSA, and her mother also contributed $1,000 to Mary's HSA. Mary's Form W-2 shows $11,050 in box 12 with code W. She has Form 5498 SA showing $4,150 in box 2. Mary has Form 1099 SA showing her HSA distributions, where she paid the following: $500 for 9 visits to a physical therapist for her knee surgery, $1,000 for unreimbursed doctor bills, $280 for prescription medicine, $1,500 for replacement of a crown, $300 for deep cleaning for teeth, $40 for over-the-counter medication, $260 for gym membership for her general health. Mary is a U.S. citizen with a valid Social Security number. Mary is eligible to contribute an additional what to her HSA because she is age 55 or older? 0, $850, $1,000, or $2,000. I don't know if
How much did she do before?
I can't hear you.
How much did she do before? It scrolled off.
It said during the year, Mary contributed $2,000 to her health savings, and her mother also contributed. But the question is, how much additional could she contribute because she's age 55 or older?
$1,000.
That's correct. So 6 is C. Number 7 says Form 8889, Part 1 is used to report HSA contributions made by who? Mary, Mary's employer, Mary's mother, or D, all of the above?
Mary,
Number 7 is going to be D, all of the above. What is the total unreimbursed qualified medical expenses reported on Form 8889, Part 2? I don't know if anyone has a calculator, so number 8 is going to be B. That is going to be 3,620.
Is that just the sum total of all those numbers
Um,
there on your page?
No.
everything was included except the gym
Gym
member.
membership?
Yep.
Yeah, I didn't think you.
Mm-hmm.
Right.
Yeah, everything but the gym membership. Scenario 4 says Cheryl, age 62, is single. She owns her home and provided all the costs of keeping up her home for the entire year. Her only income for 2024 was $48,700 in W-2 wages. Cindy, age 24, and her daughter Carrie, age 5, have lived with Cindy's mother, Cheryl, since Cindy separated from her spouse in April of 2023. Cindy's only income for 2024 was $24,000 in wages. Cindy provided over half of her own support. Ms. Linda, yes, it's fine. Cindy provided over half of her own support. Carrie did not provide more than half of her own support. Cindy would not file a joint return with her spouse. All individuals in the household are U.S. citizens with valid Social Security numbers. Cindy would not file a joint return with her spouse. All individuals in the household are U.S. citizens with valid Social Security numbers. No one has a disability. They lived in the United States all year. And if anyone else needs to leave, that's fine. It's after 9 o'clock. I want to be mindful of anyone's time. I only wanted to go over the advanced scenarios through 6, just to help anyone with this with the certification. For the purpose of determining dependency, Carrie could be the qualified child of who? Only Cheryl, only Cindy, either Cheryl or Cindy, neither Cheryl nor Cindy. You all are correct. It is C. Carrie could be the qualifying child of either Cheryl or Cindy. Number 9 is C. Which of the following statements is true? Cindy is not eligible to claim Carrie for the EIC because her filing status is married filing separate. Cindy is not eligible to claim the EIC for Carrie because she is under age 25. Cindy is not eligible to claim Carrie for the EIC because her income is too high. D, none of the above statements is true. Number 10, the answer is D. None of the above statements is true. Advanced scenario 5 for Elizabeth. Elizabeth is 54 years old and files as single. Her 2024 adjusted gross income is $52,000, which includes gambling winnings of $2,000. Elizabeth would like to itemize her deductions on Form 1040 Schedule A this year. Elizabeth brings documents for the following items: $9,500 hospital and doctor bills, $6,000 contributions to savings account, $36,000 state withholding, $3,000 personal property taxes, $600 friends personal GoFundMe, $350 cash contributions to the Red Cross, $200 fair market value of clothing, $7,300 mortgage interest, $2,300 real estate tax, $1,500 homeowners association fees, and $4,000 gambling losses. Elizabeth can claim the $1,500 homeowners association fees as a deduction on her 1040 Schedule A. Is that true or false?
False.
That's correct. That's false. What amount of gambling losses is Elizabeth eligible to claim as a deduction on her Form 1040 Schedule A? Is it A, 0, B, 1,000, C, 2,000, D, 4,000?
C, I think. Net loss.
Now remember, she had 4,000 of gambling losses.
And she had 2,000 of winnings too.
That's right. Oh, but they'll net out, right? You'll put 4,000 on A and 2,000 in your income line, right?
But she can only claim the amount of losses at up to the amount of winnings. So the answer is C. So 12 is C. Advanced scenario 6, David Stone is 28 years old and single. He provides all of his own support. David works at a gas station and earned $18,500 in wages. He took 2 management courses at a community college to improve his job skills. He was less than a half-time student. He wants to know if that qualifies for any educational tax benefit. He took an early distribution from his IRA of $2,000 for tuition and $500 for emergency repairs of his air conditioning system. This is the first time he has taken a distribution from his IRA. He is a U.S. citizen and lived in the U.S. for the entire year and has a valid Social Security number. David is eligible to claim the American Opportunity Credit on his 2024 tax return. Is that true or false? That's correct. That is false. He can take the lifetime learning credit, but he can't take the American Opportunity Credit. So 13 is false. That's B, false. 14, for which of the following IRA distributions will David owe an additional tax of 10%? $2,000 for tuition, $500 for emergency repairs, C, both A and B, D, neither A nor B.
C.
I'm not sure the repairs are.
The answer is D, neither A nor B.
Is that education's not an acceptable early withdrawal?
Yes, and so he won't owe. It said for which of the following will David owe and it said will David owe an additional tax? It said neither A nor B. 14 is D. It said neither A nor B. Any questions or concerns on scenarios 1 through 5? 1 through 6, I'm sorry.
Hey, Mr. Rucker, what's the title of this form 6744? What's the title of that form? Does it have a title on it?
No, it's just 6744. Well, it's the VITA TCE Volunteer Assisters Test and Retest. I'm trying to get to the top of it for you.
Great, thanks.
I'm going to put my email in the chat. So if any of you have any questions after tonight, you can email me. So if you have any questions,
And I'm assuming we can find this form will be in the quick links, or access of that form in the quick links on our link and learn.
yes, or you can find it at irs.gov. See if I can copy it for you. You can find it at irs.gov. I think Hunter may have emailed it. If not, I will get him to send that out. But I did drop my email in the chat. So if any of you have any questions after tonight, you are more than welcome to send me an email in relation to anything that we have covered, in relation to any of the scenarios that you may come across. And I'll be more than happy to walk you through any of it or answer any questions that you may have.
Hi, Ms. Rucker. I sent a email to you on Tuesday.
Okay.
I don't know if you had a chance to look at my email or not.
What email address did it come from?
Should be ewoodard, #2 at Gmail. I'm sorry, ewoodard0 at gmail.com.
Yes, Hunter did send it. I'll find it and send it to you.
Okay, thank you.
Any other questions or concerns? All right, if there is nothing else, Ms. Dolores stated that if anyone needs a hard copy of the form 6744 or the publication 4012, to give her a call, or you can pick up a copy at the United Way. on Tillman. All right. If there is nothing else, I won't prolong or keep you all any longer. Thank you all for allowing me to instruct you all, to give you the information that I have. Please reach out to me. Send me an email with any questions or concerns you all may have. At any point, if I don't respond to your email, shoot me another email, reach out to Hunter, let Hunter know that you have sent me an email. I have not responded, so that he can get in touch with me, so that I can get in touch with you. If I have not responded to you all, I don't want you all to think that I'm not being responsive to you. I do want to be. So if I have not responded to you, please reach out to me again, or reach out to Hunter, so that I can respond to you. I do want to be a help in any way that I can. If you all are a site coordinator, or if you have a site and you are in need of help at that site, I am more than welcome to come to the site to be of assistance to you if you are in need of that as well. So let me know in that respective as well. All right. Have a good rest of your evening and weekend coming up. Be safe and stay warm.
Thank you.
Thank you.
You
Have
are
a good
welcome.
night.
Thank you.
You can choose what site you are at. If you need a copy of the available sites, you can reach out to Hunter. Or I think you may be able to go to United Way's site website to get a copy of that site. But if not, I think Hunter can send you a list of the available sites. I know that the malls are super sites, but for the smaller sites, I think Hunter has a list where we should be able to email you a list of all the sites that are available. So you can reach out to him for a list of that, but you choose what site you want to volunteer at. No one has to tell you. You can choose what site you want to go to. All right. Thank you all.